Good day. Welcome back to Real Estate Whiskey Talk. This week in the studio, we're joined with Sam with Generations Bank, who's going to give us a little insight and forethought into what credit score is, kind of some of the impacts it has on your mortgage, and how to work on building it up and or repairing it if need be.
So my name is Sam Piche, and I am the market president currently at Generations Bank down in Kimberling City, Missouri.
Okay. So here talking today, trying to figure out as a potential home buyer, what are the steps to figuring out where my credit is? Like, how do I rebuild credit? How do I build credit for the first time? What are some good tips and tricks to help raise your credit score? Because at the end of the day, that credit score, A, will make or break the transaction and can dramatically impact the interest that you'll be charged.
Yeah, exactly. It can actually affect your payment, and it can affect it long term. So the very first place that I would say to start looking is go online, and you can actually pull your own credit if you want, just to kind of give you a baseline to start looking and figuring out. And one, that's going to kind of give you a baseline of where you're at. Two, if you look at your own credit score before you even have the bank do it, a lot of times you're going to find that there could be some things that you're going to want to contest on there to start. It's between normally 20 to 30% of individuals that actually look at their credit scores that actually have something on there that they didn't know was on there.
It wasn't theirs.
It wasn't even there, so they didn't even know it was there. And it's a very common thing for it to happen. The government's dealing with a lot of people, and they're seeing all kinds of stuff come across the table all the time. So a lot of times stuff ends up on your credit that you didn't even know was there, and it can pull your credit down. So that's the best place to start. One, and then two, you want to start looking at FICO score models. So I would look at a FICO score model. Basically, at the end of the day, how is a credit score broken down? So a credit score is broken down into different percentages, and based on that is how you can actually rebuild or how your credit might have gone down.
Because they all account for different values of that percentage of the total score.
Right, of the total different score. So some are in the 30s, some are in the 10s, and again, if you look at a model, it can kind of teach you that. One of the things that people get hung up on sometimes is the smaller 10%, which, one of those is the credit history, or basically the longevity of your credit, what that looks like. Not so much just making payments, but how long you've had credit. Don't get too hung up on that. The bigger mix that you want to have is just a mix of credit. So based on, do I have credit cards? Do I have any type of car loans? Do I have a mortgage on my credit history? And then with that mix, how long have I had that basically history of making payments consistently? One of the things to look at when it also comes to credit cards and things of that nature is how many do you have? What types of cards? I know a lot of the times the IRS, or those that are looking at doing FICO scores and all these types of things, they're even looking at the different types of cards. So some people might, if you're going to Sears and you're going to Hobby Lobby,
credit card everywhere,
Walgreens, and it's like, hey, every time they offer it to you, well, you're opening up multiple different credit cards. Well, you want to kind of limit that. Usually they say, you might want 2 or 3, and just like a normal card, and then you want to kind of limit yourself to maybe one of those type of score type credit cards. If you start getting too many store type credit cards too, they start kind of looking at that. So again, it's not bad. I know some days the different types of generations like to play the point system, the travel system. You can do that, and it's not going to hit it too hard.
But consolidate them to one if you can.
But you want to try to consolidate. You want to get too high. And then also when it comes to credit cards like that, you really want to keep it's really based on your percentage of your usage. And that's really goes off your.
I got dinged on that the other day.
Yeah, it's a thing to watch, and it's really based off your entire usage. So, again, say you have 5 credit cards at $10,000 limits each. You really want to try to keep yourself below that 30% max, but realistically, you actually want to try to keep it below 10% usage if you can. That 10% usage range will put you really in a good market to keep your DTI, which is your debt to come ratio, whenever you're coming in to talk to a bank, kind of keeping it lower. And it's kind of look and say, hey, not only for your credit side will it give you a good credit score, but then as a bank, as they're looking down, they're kind of seeing how much usage you have as well, and then basically how your bills compared to your income stack up. And if it's low enough, that actually sets you up in a good spot. And at the end of the day, realistically, it could actually save you a little bit of money. So one of the things to do when we start talking about rebuilding credit, because I know it's kind of our topic, one of the things to do is to start looking at how can I get my usage down to that? Can I get my usage down to below 30% to start for overall?
Get consolidated.
Start getting consolidated. Can I get it down to 10%? Sometimes I even run into other individuals, though, on the other side of the spectrum. They say, I've never had credit. I've never really used credit. I've only had cash. I'm only at this age. Start with a little $2,500 loan from the bank. Sometimes that's the best.
Just had a client lose out on a potential property because he's in his 50s and paid cash for everything in his life.
Yeah.
So he has 30 grand in the bank that he was talking to about the loan. Like he could write a check for the down payment. But they're like, your credit score is 0 because you're not in the system.
Right.
I mean, and I feel worse because he's a veteran, but it's like there's nothing they can do fast enough. Mm-hmm. So they've got the bank set him up with a credit card. It's like a $500 limit, $1,000 limit, super small.
Right.
Just to have the history.
Yes.
So
and even on those types of credit cards, like Drew's speaking to, sometimes those that you can literally borrow against your own money. That's another good way to go. So if you can start with a bank, somebody that doesn't have that type of credit history, you can take a card out that'll actually hold X amount of dollars, and it's used just as a credit card. It'll pull it from an account, but it'll start showing that payment history. Same thing if you have savings accounts or CDs, anything of value that has equity to it, you can a lot of times borrow against that. You're borrowing against your own money. And it's actually cheaper. Interest rates, it's always cheaper to borrow against your own money, but it also at the same time will help you build credit because you're showing that you can consistently make those payments. So that's always a good avenue.
Well, then, I mean, like, even if it starts simple with, like, get a credit card just to purchase gas or just buy groceries on and nothing else.
Right.
Like that track record of month after month after month, 3 to 6 months in, you'll start seeing those dividends coming back and your credit score slowly climbing.
Mm-hmm. One of the things to know about credit cards too is just because your payment cycle is X day to X day, it doesn't mean that that's whenever the company actually reports or sees whenever your credit cards come in. So we always want to know whenever the company is actually reporting what balance you owe. You could go take out, say you have a $10,000 credit card and you go to X store and you spend $7,000 on a major purchase. Well, you pay it off before your payment comes in, so you're not paying interest. But technically, you can still get dinged on that because it's the actual cycle that they're tracking per month whenever they're turning in how much you've actually used.
So that's what happened to me with my vacation. Everything went on my credit card to pay it, and I paid it off once everyone else had paid me their portion. And it was still before the payment cycle was over, but my credit score went down like 7 points in a month because I went from like carrying a balance of like $20 to like $7 grand on a $10,000 card. I went from very little percentage to, like you said, 70% of that card's percentage.
Right.
They're like, whoa. And it is what it is. I'm just thankful, like I said, I'm not shopping right now for anything, but that's caveat back is always like on the mortgage side, you're not going to want to make any drastic changes on anything because they're going to be pulling records for the last 3 to 6 months. You don't want any fluctuations on either end of that.
Right.
But building it up will always be good.
It's always good. And one of the things I noticed, like Drew just mentioned, sometimes the bigger purchases, during tax seasons or things like that, we start seeing different purchases come in. But if you're thinking about those bigger purchases and it's the type of place that you're shopping, so a lot of times I'll see if you go to a car dealership and they use a brokerage to kind of shop your rates, well, they could hit your credit 20 times because they're a brokerage. And it looks like, and every one of those major hard inquiries is a ding that's going to show on your credit for a while. So definitely when you're shopping around for even any type of purchases, if you're looking at furniture, it doesn't matter what it is, just kind of know if it's a hard inquiry, if it's not, and how much that's going to ding you, because you don't want to have too many hard inquiries. That's also one of those FICO score percentages within that year. So,
and I assume 1 or 2 is okay.
1 or 2 is okay, but when you start,
10,
when you start
15,
getting up there, it does start hitting you a little bit.
So it is real estate whiskey talk, and we completely forgot the caveat. Sam is drinking a little bit of coffee from Cedar Creek Coffee down the job program. My day job, we're getting ready to roll out. The cafe should be open in a week or 2. Job program for specialties adults down in Branson. And I am, however, enjoying Johnny Walker Green Label. And it is as far as I know, one of the first all malted blends of scotch that Johnny Walker's put out. And it is delightful, wonderful. It is all the great things. So I just wanted to plug that in real quick. So caveat back in here, if you're thinking about buying and you're not sure where your credit is, first step, run your own credit report.
Run a credit report, know where you're at, understand credit. Obviously, this is a YouTube video. There's some great YouTube videos out there. There's some great things that you can go and do some research. Definitely doing your own little research and learning. And then once you're doing that, then obviously going to your local bank, you can also talk to them, have an expert kind of talk to you.
Because like if you've got, like I love the CD savings account credit rebuilding thing. I did that for a friend of mine, and I had to loan him the money for the CD, which is a different problem, but like it locked the money up secure, and then basically it cost him like $45 in interest over 6 months, and it counted as an installment loan.
Right.
And I stand by the fact that he could have gone and bought a car. Yet again, would not have been a good purchase for him, but then he had to carry full coverage.
Right.
So like it counts as an installment loan without all the other due process to an installment loan, which is a bigger bracket in your FICO credit score. So,
right.
So yet again, I want you to tell everybody where you are and how to find you.
My name's Sam Piche. I'm over at Generations Bank down in Kimberline City. Been a bank around for 115 years, and we just love doing community banking. And if you need anything like that, or if we can help you, we can even help direct you to the right person if we're not the right fit. So we'd love to come see you in branch or over the phone, or you can even find us online at mygenerations.bank.
And that's something that tends to be very common in the people I invite to the channel, community first.
Yep.
And I'm glad to know that just one of the other banks in the Branson metro area that actually cares about its community and is doing a difference to make a difference. So thank you and have a good day.
Later.
Thank you for watching to the end of this week's episode on Real Estate Whiskey Talk. As always, we're looking for other industry leaders in our real estate world that want to come and visit the studio and bar, maybe try some whiskey and talk about their industries. And we're always looking to help people reach their real estate goals. So if you need anything, please reach out as well.